Welcome back to the next lecture of financial institutions. So in the last lecture we discussed about the banking sector reforms, we discussed about the Narasimhan committee, and then we discussed the recommendations of Narasimhan committee, then we discussed about the MCLR, marginal cost of fund based lending rate, and then finally we discussed about the recommendations of the PJ Nayak committee. So one of the recommendation of Narasimhan committee was India should implement the Basel norms. So what exactly is Basel norms? So in today's lecture we will discuss about different Basel norms, the need of Basel norm, why we felt Basel norm is required to be implemented in India, which body is there which governs the Basel norms, whether the Basel norms are being implemented or not. Some international body should be there. Then we will discuss the technicalities. What is capital adequacy ratio? The exact definition. Today we will discuss the tier 1 capital, tier 2 capital, the Basel 1, Basel 2, Basel 3, the new things in Basel 3, and some critical analysis of Basel 3. So all these things we will discuss in today's lecture. So first of all, we will discuss what is the need of Basel norm. The name itself shows it is just a norm. It means it is not mandatory to implement it. They are not binding in nature. They are just suggestions. They are just norms. Then who gives these norms? Bank of International Settlement was established in 1930. When 1930 Great Depression came, so at the international level, the demand was felt that some international bank, some bank of the central bank, it should be established. So BIS, Bank of International Settlement, was established in 1930 at Switzerland. This BIS, over a period of time, in 1988, BIS established a committee, that is Committee on the Banking Supervision, and this Committee on the Banking Supervision recommended different Basel norms. What all things should be included in Basel norm, what different norms should be there in the Basel norms, and their target as well. What should be the target of tier 1, what should be the target of tier 2. So all these things they were recommended by the Committee on Banking Supervision. Then why we need norms? The thing is, bank is the basic backbone of any economy. So we should have different indicators. First indicator to measure riskiness of the bank, second indicator to measure, third indicator to measure. And if you are measuring these indicators, these are the ways through which you are measuring the risk. There should be some norms, some solutions, predefined solutions should be there. So just like we have NPA. So NPA is one tool through which you measure the riskiness of the banking sector. Capital adequacy ratio is one more tool through which you can measure the riskiness of the banking sector. And to avoid all these mistakes in future, Bank of International Settlement prescribes the Basel norm. Then we have one more reason why we should implement the Basel norm is, suppose this is India, these are some European countries, these may be some African countries or Latin American countries. So if one branch of SBI is having office in India, the second branch is having office in these two European countries. If India will not implement the Basel norm and these two countries have implemented the Basel norm, so they have to fulfill whatever is required in these Basel norms. So how we will do the analysis? This branch of SBI will send the data in India, but the format will be different. This branch has to maintain the data in the format prescribed under Basel norm. The requirement will be as prescribed in the Basel norm. In the globalized era, when all these economies they are integrating with each other, so there should be some common minimum terms. Just like in case of polity, we have fundamental rights. So fundamental rights are not absolute. It means the government or the executive, they can take away some of the fundamental rights of the individual for the betterment of the full society. We have individual fundamental rights. Government can take away some of these fundamental rights during some contingency situation for the betterment of the society. Similarly, all these countries are sovereign countries. We should decide our own monetary policy, fiscal policy, but for the betterment of across world, because we are integrated. 2008 recession, India has no mistake, but still we got impacted because we are integrated. This world has been integrated. This is known as the global village. All these countries, these economies, they are integrating. So some of these sovereignty to decide the monetary policy, it should be taken away by Bank of International Settlement, and BIS should prescribe some of these norms. These norms as such, they were prescribed in Basel 1, Basel 2 and Basel 3, but it should be like in India we have a concept like CRR and SLR, but in USA there is no concept like CRR. So there should be a compromise which this Bank of International Settlement should prescribe. Then what should be the value of CRR and SLR can be decided on by the respective central bank. But as such, there should be some concept like that, that in so generic form they prescribes, or the BIS prescribes the norms. Once again, the norms of the Basel are not mandatory to the member. Almost more than 34 members are there. But all these 34 members, it's not mandatory. Even if you are a member of this BIS, still it is not mandatory to implement the Basel norm. But why we are implementing? Because we have to integrate. India is integrating with different economies. So there should be a commonality. There should be common. The record keeping, the different CRR, SLR, all these tools, they should be common. So this is what the need of the Basel norm. Then we will discuss the tier 1 capital, tier 2 capital, different tier that we have. So in the capital adequacy ratio, the definition of capital adequacy ratio is CAR equals to tier 1 capital, also known as core capital, plus tier 2 capital, also known as supplementary capital, upon risk weighted assets. This we discussed. In the previous lectures we discussed it is nothing but paid up capital upon this. But tier 1 capital itself is made up of paid up capital plus it is made up of statutory reserves plus disclosed reserves. So what exactly paid up capital means? The promoter's money. When you want to start a company, your own fund is known as paid up capital. Now the statutory reserves. What is the statutory reserves? So these are the reserves which are required to make you solvent. Plus, if you will maintain these statutory reserves, the cost of your insurance will be less. How it will be less? Because to your insurance provider, you are saying this much amount of reserve I has maintained in my accounts always. So in case of some contingency, in case of some risk, I have this much amount of reserves always safe. So that is going to decrease your insurance cost, plus the statutory reserves will make you always solvent. Then the disclosed reserves. So in case of banks only, you have this thing that whatever your profit is, suppose the profit of this bank is 50 lakh rupees. So now it is the discretion of the bank to keep some reserves as disclosed and some as undisclosed. So this disclosed reserves, which the bank is telling to the public that this is my disclosed reserve, is known as disclosed reserves. So tier 1 capital or the core capital, the core assets of the company, they are the paid up capital inserted by the promoter, then the statutory reserves maintained by the particular bank, and then we have the disclosed reserves. So these are the core capital. Then we have the tier 2 capital. So under this tier 2 capital, the first one is undisclosed. The amount which you are not disclosing is the supplementary. Of course, that is a type of capital. Of course, that is your asset. But in the priority order, it is known as the second priority. It is tier 2. It is just a supplementary of the core capital. Then first we have the undisclosed. Then we have the preference shares. We discussed that the normal shares, they got the least priority. But preference shareholders, they got preference above the normal shares. So preference shares, they will come under the supplementary capital. And then the third one, that is known as subordinate debt. From exam perspective, these things are a bit technical, but because Basel III is in news, these things can be asked. Which of the following does not come under tier 1 capital? Which of the following does not come under tier 2 capital? So revising it, tier 1 means paid up capital, statutory reserves, disclosed reserve. Tier 2 is undisclosed reserves, preference shares and subordinate debt. Let's discuss what is subordinate debt means. So suppose this is bank, SBI is there, and SBI has created a mortgaged backed security. SBI has given a loan to A, and in return A gave the house paper. On the basis of these house paper, you have created a mortgage backed security which you have sold to somebody else. So this mortgage backed security will be the example of subordinate debt. When you will liquidate this particular thing, when you will liquidate suppose anything, the order of preference will be the normal debt, whoever is the bondholder, the normal debt. The second priority will be given to the subordinate debt. The third priority will be given to preference shareholder, and the last priority will be given to the shareholder. So this is what at the time of liquidation. This again can be asked in the exam. What is the order of priority if a company liquidates? So first one is debt, second one is subordinate debt. The example of subordinate debt we discussed, this mortgage backed security that we discussed, because MBS is deriving its value from this. When you have created this MBS, so as such there is no existence of this MBS, but you are deriving the value of MBS from this thing. So here you are selling this MBS maybe to A. In return, when you are selling this MBS to A, in return A is giving you some money. So this debt will get the second priority. Such type of debt, A will get the second priority, because A has not directly invested in SBI. A has purchased a derivative security. So first, whoever has given a direct loan to SBI, suppose SBI issued some FD, so this FD holder B will get the first priority. Then this A will get the second priority, because A has invested in this mortgage backed security, which is a derivative security. So of course A should get some money, but A will get the second priority. The third priority will be given to the preference shareholders of SBI. Suppose SBI has issued 10 preference shares, so that preference shareholders will get the third priority, and the normal shareholder of SBI, they will get the last priority. So this is the order of liquidation: debt, subordinate debt, preference shares and shares. I hope the concept of subordinate debt is clear. Subordinate debt means it is a type of debt only. Why it is a type of debt? Because SBI is borrowing something, but the manner in which SBI is borrowing is by using a derivative security. So through derivative security, when you are borrowing, so this becomes an example of subordinate debt. So subordinate debt is a part of tier 2 capital. Then we have types of risk. So there can be different types of risk. Whenever you are considering, the whole purpose of this Basel norm is identify different risks. So the first type of risk can be credit risk. Just like in risk weighted assets we discussed, such type of risk can be there. Suppose you have given the loan and there is no mortgage, so there is a risk attached. Suppose you have given a loan to Government of India, so there is no risk. You have given a housing loan, it means there is some risk. To vehicle loan, there is more risk. So such these type of risk, it is known as credit risk. Then we have the second type of risk that you have to consider while framing the policy is market risk. Market risk in the sense, suppose interest rate is increasing. So you have to count if the interest rate increases exponentially, what will be its impact on the functioning of the bank. Suppose the exchange rate, $1 suddenly becomes 90 rupees. So what will be its impact on the functioning of the bank? All these things, all this risk you have to include while framing this Basel 1, Basel 2 and Basel 3. Then we have operational risk. This operational risk is nothing but which is not in your hands. When you operate, the environment in which you operate, there is some risk which is associated to this environment. Just like if flood comes, some fire comes, there is hacking on your website, some fraud comes. So all these are the externalities. So these external risk also you have to consider while you are framing your Basel norms. So this is known as operational risk. Under Basel 1, only credit risk was counted, because at that time the intellect of the Committee on Banking Supervision was not that much to count all these type of risks. So during Basel 1 they counted only credit risk. The second negative of Basel 1 is there was no differentiation between different types of debtor. Suppose we have one debtor and the risk profile was not there. No risk profile of different debtors has been created. If this person is Vijay Mallya, or this person is Sahara Group member, or this person is Indigo Group CEO, or this person is Infosys Group. So this differentiation of different debtors, there was no such provision. So if you have such provision, then accordingly you can make the risk profile. Just like for individual cases, we have something that is known as CBIL. So CBIL gives you the marks out of 1000. I think an advertisement comes related to CBIL. A person visited a bank and there was a huge queue in that bank, and the person that was standing there, he said my CBIL score is 850, and suddenly the executives started running towards that person. So CBIL is your score out of 1000. Just like we have CRISIL. CRISIL is a rating agency which rates to different companies. Suppose one company wants to come up with some debenture, so CRISIL will give rating to that particular debenture. One company which is coming with some IPO and all these things, so they will give some rating. Similarly, we have international rating agencies also that we discussed, S&P, Moody's, Fitch. At the company's level we have CRISIL. At the individual level we have CBIL. So just like to the individuals you give these scores, to this CRISIL you give this, to the companies you give this rating when they come up with the debenture or the IPO, FPO and all. So similarly, there was no differentiation between different debtors in Basel 1, but there were lots of positive things, lots of positives of Basel 1. It was like it set up a benchmark across the world. It increases drastically the value of capital adequacy ratio. It was very simple in nature. So all these are the positives of Basel 1. Then we will discuss Basel 2 norm. In India it was implemented in 1999. Then we will discuss the Basel 2 norm. So Basel 2 implemented in India by 2009, just 1 year after the recession came. So under Basel 2, they counted all the types of risk. Be it, we can remember it with CMO, Chief Medical Officer. So be it credit risk, market risk or operational risk. So all types of risks they were counted under this Basel 2 norm. And the capital adequacy ratio, its value which was stipulated, it was 8%. But within India, the Basel said it should be 8%. But RBI, Papa, domestic regulator, our regulator said it should be 9%. So for Indian banks, it was the banks which were in India, they have to fulfill 9% only. So as per Basel 2 is what? 8%. Similarly, as per Basel 3, it is 10.5%, and from with RBI is saying it will be 12%. The deadline is 2019. So exact figures we will get to know in 2018 and 19, but right now it is 12%. Now within these CAR, there should be minimum criteria for tier 1 and tier 2. Similarly, here also there should be criteria for tier 1 and tier 2. As per Basel 2, the tier 1 and tier 2 both should be 4% and 4%. In Basel 3, they have improved the quality of capital by making it 6% and decreasing it to 2%. Then 6 plus 2 is 8 only. How come they have come up with 10.5? Because they have created new features. These new features we will discuss in the Basel 3 now. So now, because the Basel 2 failed, the regulatory lapses, the regulatory reasons and the consequences led to Basel 3 norms. The recession came, which clearly shows that the Basel 2 norm was unsuccessful across the world, because that recession came because of banking sector, and we already have this Basel 2 norm. And when the recession came, it clearly shows that Basel 2 failed miserably. So when this Basel 3 came, it was because of the regulatory failure. Following new features, these are the new things which were added in Basel 3 norm. Just like it widens the scope of operational risk. The third type of risk, it widens the scope. New things have been added. Then the disclosures. More information the bank should share with the shareholders, with the market, with RBI and all these things. Exactly what are these things, that we don't know, because the deadline is 2019 and this is only 2016. So once this information will come, then that may be relevant from exam perspective. But the topics which I am covering, this Basel norm, the things which I am discussing under Basel norm is more than enough from any exam perspective. Be it any exam, SSC, RBI, state PCs, UPSC, it is more than enough. Last to last year, UPSC asked one question, Basel 3 norms are related to which of the following things? And they asked, one option was the banking sector. So such simple questions UPSC has asked. The state PCS or SSC can ask some different questions, some factual questions they can ask, like what is the tier 1 target under Basel 2? What is the tier 1 target under Basel 3? So some factual questions can be asked. The next major change in Basel 3 is the better capital quality. This also we discuss how it is better capital quality, how it is better, because the tier 1 has increased to 6%. Earlier it was 4% in Basel 2. So now it became 6%. Then the counter-cyclical buffer. Now this is a good concept. The counter-cyclical buffer says the economy can face two types of situation. First one is the economy is booming when there is huge growth and when there is recession. Counter-cyclical buffer, CCB. So when the economy is growing too much, so at that time there are chances of inflation in the economy, because more boom will be there. Inflation is always associated with the growth. More demand will be there, so inflation is possible. So how to curb inflation? You can curb inflation by decreasing the money supply. So this money supply should be removed from the banks or the economy, and it should be stored with the central bank of any country. So it will be kept as a reserve, a separate reserve, which is different from the existing. In India we have this CRR, SLR and all these things. We are talking about international norms. So counter-cyclical buffer will be a special buffer which you have to maintain with RBI when the growth of the economy is huge, and the minimum and the maximum value of CCB will be 0 to 2.5%. Now what should be its value? That will be decided by RBI, but its value should be in the range of 0 to 2.5%. So when the economy is heating, when too much of growth is taking place, maybe RBI said its value is 2%. So more money will go, extra money will go and stored in the RBI. So the money supply in the economy will decrease. That may decrease the inflation in the economy. And whenever there is a recession in the economy, in case of recession, you need extra money. So that extra 2%, this 2% suppose was the value, the maximum can be 2.5. But suppose RBI said for India it is 2% for this year. So this extra 2% will be released by RBI, and that can be used at the time of recession, because at the time of recession you have to increase the lending so as to increase the demand, so as to increase the purchasing power of the society. So during growth time you will remove this extra liquidity so that to curb the inflation, and during the time of recession this extra liquidity can be injected from the central bank so that more and more lending will take place, and that can look after the impact of recession. So recession can be to overcome recession. So this is known as the counter-cyclical buffer. So this is very interesting thing. When the economy is growing, at that time the value of counter-cyclical buffer will be more, and when there will be recession, the value of counter-cyclical buffer can be as low as 0. So this is the new concept, counter-cyclical buffer. Then we have a new concept that is known as a leverage ratio. So we discussed capital adequacy ratio, and that capital adequacy ratio is nothing but the tier 1 capital plus the tier 2 capital upon risk weighted asset. But if you are dividing this tier 1 and tier 2 upon total assets without weighing it, without taking the average of the risk profile, whatever amount you are lending, multiply by whatever the risk that is associated, taking the average, that is known as risk weighted assets. But in case of leverage ratio, you are considering tier 1 capital, tier 2 capital divided by assets. So that is what the leverage ratio, that is a new concept. At present its value should be 3%. The present value, the initial value is 3%. Now finally that will be decided by the central banks of the respective countries. The next we have is liquidity coverage ratio. You have to cover your liquidity, just like we have SLR. So what is the role of SLR? Statutory liquidity ratio is whatever liquid assets that you have, maybe you will invest in any of these 4 options. These are cash, gold, unencumbered government security and excess reserves. Similarly, liquidity coverage ratio, LCR, will look after your 30 days stress period assets. The objectives of SLR we discussed. In case of bank run, this amount of assets which are being saved, because most of these assets, they are being stored in the government security. So these assets whatever are available with the banks, in case of bank run, these assets will be sold in the market and the money of the investors will be returned. Similarly, a very similar concept to SLR has been prescribed, that is liquidity coverage ratio. It means 30 days stress period assets the banks has to maintain. It is also same as the SLR. SLR is the general one and it is only for the 30 days stress period. Whatever the total assets of the bank of 30 days, that the banks has to maintain. Now as per the national thing, you have to maintain SLR. Now because I am saying India will also accept the recommendation of Basel III, so India will also cover LCR. So a lot of money will be stored with bank only. That is why Urjit Patel committee, they said India should adopt only LCR, which is an international commitment, and we should abolish the concept of SLR. But because we still have time, the deadline of Basel III is 2019, so right now SLR has been continued and liquidity coverage ratio has not been implemented in India. Next we have is net stable funding ratio. This net stable funding ratio is nothing but to check the asset liability mismatch problem. So to incentivize the banks so as to collect the money from some stable source. You know, one of the major reason of Basel III of the one of the major reason of the recession was in developed countries the banks were undercapitalized. The banks were not having any money because in developed countries the shadow banks, the money available with shadow banks was more than 3 times the money available with the banks. So the banks were undercapitalized, and when you are undercapitalized, but you have to perform, you have to sustain. So to make your particular business viable, you started borrowing for short duration. Because for short duration, the rate of interest is less. The banks has to pay less interest in case of short duration. But banks were lending for more long duration. So that created an asset liability mismatch problem, because 2 reasons. Developed countries banks, they started borrowing for short duration, and the funds available to the banks were not much because funds were shifting to the shadow banks, also known as NBFCs. So to incentivize the banks to take the funds from some stable sources, or there should not be any asset liability mismatch problem for 1 year, this net stable funding ratio will be prescribed. And now what will be its value and all this thing has not been disclosed by RBI, but this is as per the concept. Net stable funding ratio will be used to stabilize the borrowings of the bank for full 1 year. For short duration, liquidity coverage ratio. For long duration, net stable funding ratio. Then the last initiative is G-SIB. G-SIB is nothing but globally systematically important banks. So just like Lehman Brothers filed bankruptcy. So Lehman Brothers was such a huge bank. So by learning from that mistake, under Basel III we came up with the concept that whatever these big banks, these big international banks are there, you have to take special care of these banks. The transparency norms, the disclosure should be more than the normal banks, because we as the world economy cannot afford that any of these banks files bankruptcy. So what we did is we give extra targets to these banks. Just like if for the normal bank the capital adequacy ratio is 10.5, so for these banks it can be 11%. If you have to disclose this much of the information, but for G-SIBs you have to disclose an extra bit of information. Across the border should be transparency. It should not be like if it's a big bank having one branch in Europe and the second branch in USA. So this Europe branch don't have to disclose any information to the USA branch. So the disclosure norms, they all has been expanded. So this is what the G-SIB is. So how many Indian banks are mentioned in G-SIB? Option 2, 3, 4, 5. Of course 0. Because no Indian bank is so big. That is what we discussed. That is why the need of authorized bank investor suggested by PJ Nayak committee. So no Indian bank was mentioned in G-SIB. So who cares? RBI said we will use our Desi SIBs, not a problem. If none of our bank came in the global systematically important banks, so we will come up with our Desi systematically important banks. The full form is domestic systematic important banks. And every year RBI will announce 2 or 3 domestic systematically important banks. I think SBI and ICICI. Right now RBI has disclosed that ICICI and SBI, these are the 2 domestic systematic important banks. So these are the things which are more than enough related to the Basel norms. Thanks a lot.